Okay, I guess we'll get started. Thank you all for joining us and visiting as we talk about mergers and acquisitions. This will be recorded, so we will also be sharing the link after all is said and done. I am Holly Corcoran. A little bit of background about myself is I started my solo practice as a traditional CPA in 1991, and in 2013 took on a partner and merged our practices, and then in 2024, we decided to sell, and I rewired my practice to be entirely business advisory and advanced tax planning for veterinary practices. So that is my new mission. And outside of work, I enjoy riding horses, and I'm an FEI endurance horseback rider. And I found that my sport actually helps me kind of chunk things down and helps me make plans, because when you're riding a horse for 100 miles, not everything goes to plan, and sometimes you have to adjust and go forward. And I find the same thing in businesses. So I will be talking about the tax strategies and considerations, and Justin will be talking about the legal ramifications and common mistakes made by veterinary practices in the merger and acquisition process. So I want to talk first about the importance of planning early. And I want to talk first about with the buyers. You know, you don't necessarily wake up one day and decide that you're going to buy a veterinary practice, or that you're going to go out and do a startup or anything like that. You want to decide what type of practice you want to be in. Where do you want to be in? Can you be in your local area, or are you subject to a non-compete as it is right now? And when? I would suggest giving yourself at least a 6-month window, because there's things that you're going to want to put in place, such as a business plan. You're going to need to look at your financing, work with the bank, make sure those pieces in place, and have an understanding as to what you're able to buy. And the business plan, I find, is really important because it helps you create a roadmap as to where you think the end practice is going to go. And it also gives you something to compare to once you're actually running, and to see if your expectations meet the actual results. So the other side of it is looking at the seller. And I suggest that the seller really take probably 2 to 3 years looking out as to when they're going to sell their practice. And actually, with any of the practices that I work with, I ask them, at no matter what stage they are in their practice, to pencil in a retirement date, because we have seen that sometimes any type of practitioner, CPAs, vets, whatever, attorneys, will sometimes get into practice and say, oh, well, I'll figure that out when I get to that time. And it's really good to kind of have it on the horizon to know when you're going to be looking to sell. And the reason is that even if you hadn't penciled that in, and you're suddenly coming to that point where you realize this is the direction you want to go, you give yourself 2 to 3 years so that you have your financial statements in order. You have good, clean tax returns that you can share with the buyer. And also you can document your procedures. You know, your employees on a day-to-day basis, it's very beneficial because it helps your employees know, where they, how the practice works and how the procedures look. But as a seller is coming in, or excuse me, a buyer is coming into the practice, it gives them greater confidence that it's a smooth running venture. And you want to be able to give them the greatest confidence in buying the practice and positioning the highest value possible. The next thing I wanted to talk about is understanding what you're buying or what you're selling. And I talk about either an asset sale or a stock sale. And first, I'd like to talk quickly about a stock sale. And what that is when you have an interest in an S corporation or a partnership, or an LLC or a C corporation, and you have that interest and you're selling that interest, the stock per se, then you're buying the underlying assets and liabilities. And that works fine for the liabilities that you're aware of. In other words, the seller will have a set of financial statements, and you'll know what the accounts payable is, and what the payroll taxes are, and the debts that are out there if that's what you're acquiring. But you won't know what you don't know that's not on the financial statements, such as a tax notice that's coming up, or if for some reason a client decides to sue you after it's sold, then you're buying that liability. So sometimes you have to understand what type of risk you're going into in that circumstance. The other way to sell the practice is using an asset sale. And most veterinary practices are sold as an asset sale. And the buyers and sellers need to understand what is being sold and what is being purchased, and to agree on the value of those items in each of the buckets. Is it equipment, inventory, goodwill, a non-compete component? And these are all taxed in different ways. But also you have to agree on the value, not just for the contractual relationship, but also to know exactly what those dollars are going into those buckets for tax purposes. The buyer and the seller will have conflicting desires. The seller is going to want to have more things identified as capital gains, and the buyer is going to want to have more value put into the equipment, so they have aggressive depreciation and expenses they can take on the business when they take over. But why we need this is also because when on the year of sale and the year of purchase, both the buyer and the seller affix the 8594 asset allocation to their tax returns, and that notifies the IRS that you're both on the same plane for what you're buying and what you're selling. That way, whatever is picked up is taken as a deduction in one way or taken into income on the seller side a certain way. So that form is important when you're actually going to file your tax returns. The next aspect I like to talk about is the timing of income. There's two ways to sell your practice. Basically, you could do it in a lump sum or as an installment sale. And what I like to talk about first is the installment sale basis is just as it sounds. You agree up front that the value of the practice is a certain dollar amount. Let's just say it's $2 million. And you're going to pay the seller that over, 4 years. You're going to spend $500,000 a year. There's going to be an interest component associated with it. And let's say that seller has an underlying basis in the assets they're selling of about, let's use 500,000 again. And therefore, the profit percentage on that is 1.5 million over the 2 million. It gives you 75% profit percentage. So each year, the income that you take into your tax return is 75% profit, and then that's taxed at the capital gains rates that are applicable to your tax return in that year. So it's a good way to help sometimes defer taxes, but also you have to be aware that as a seller, you're taking on the risk of possible default. And Justin can actually tell you about making sure you have things in the contract that protect your interest and make sure either that doesn't happen, or if it does, what your options are to be able to make it right again. So most practices, though, do sell in a lump sum where the buyer goes to the bank and they get a loan and they come in and they, on the day of sale, the cash transfers and the buyer takes over, and whatever the procedures are in between that have been determined, which we'll talk about in a minute. But at that point in time, the transaction is basically complete. And that year, the seller will take it into income entirely. And the buyer either way would be taking the sale into their books at the date of sale. It's the seller that has the opportunity to be able to defer taxes on the installment basis. So what's going to happen after the sale? Is the seller going to stay on post sale? Are they going to be an independent contractor? Are they going to be paid as a wage? What does that look like? And most of the time it's set up as a wage where you're withholding the taxes, and you may have certain benefits that are available, such as retirement or health insurance or whatever other benefits that are available to the employees in the practice, as well as the owner that's staying on. Or it could be an independent contractor. You may say, you know what, I don't really need you full time, but you do have to make sure that that person qualifies under the IRS to be treated as an independent contractor and have those behavioral relationships that would allow you to pay them on a 1099. But the thing to keep in mind is this is not necessarily part of the sale. It may be part of the contract, but the sale is treated as one transaction, and then the employment contract and that income is treated another way and is treated as ordinary income as it's earned, just like you file your tax return every year. So some of the planning that we can do with the seller before you actually sell, in other words, one, we want to get the finances in order for the next 2 to 3 years, but what can the seller be thinking about in their tax situation to make sure that they're taking advantage of everything they can along the way. They may have suspended losses that are out there that would help reduce any gain on that sale. I always tell my clients now and going forward to make sure they maximize their retirement contributions. But if the seller has not been doing this, they need to be able to bulk that up as they go into the sale, so that they put as much into deferred compensation as possible, because when you retire, hopefully you're at a lower tax rate and you're saving the taxes up front as the money's going in. As I talk about on the business side, like we mentioned in our webinar last month, when we're talking about cash flow strategies, creating a sinking fund within the business, and you may want to do that on the personal side to start accumulating cash, or even as a part of the sale, make sure that you designate a portion of cash and how much is going to get tied up into investments. And then paramount to that is speaking to your investment advisor. And I think some of the things that Justin will be talking about are, who are all the professionals that you are going to want in this process as you're merging or acquiring a firm, a veterinary practice. But I ask you to talk to your investment advisor well in advance of the transaction taking place, because one, your tax advisor is going to say, okay, this is going to be your residual amount based upon an estimated sales price. And then the investment advisor can tell you, based upon your risk, what you're willing to invest in, what type of cash flow stream you can expect in retirement. And it may not be retirement. You may be selling, doing something else, but you want to have those goals in mind. And if you do need it for retirement, what does that cash flow stream look like for you in retirement? And the final thing I have on this slide is NIIT, which is net investment income tax. And lucky us, once you reach a certain level of income on your return, the interest, dividends, and gains are taxed at another rate on top of what they've already been taxed at. And that is 3.8%. But what I like to tell people is that for sales of practices that are closely held as corporations or partnerships, that income from that gain may not be subject to the net investment tax. And so we wanted to keep that definitely in mind when we're doing our tax planning and when filing the return. So I suggest that you work with a tax strategist and business advisor as you're going into this big event, because you want to make sure you're structuring the deal with intention. You want to make sure that the financial reporting and KPIs are in line, or as a buyer, as you're looking at the seller's financial statements, do the numbers look good? You want to make sure you have a professional helping you look at those numbers and projecting those numbers to see where it's going to go for your benefit. You certainly don't want any tax surprises. I don't think there really should be surprises. I think there should be surprises in reverse. What I like to do is estimate high, and then when we actually file the tax return, then I can say, actually, it's a lower liability than we expected, so that you're not caught off guard. But certainly you do not want to be in a position where you're all of a sudden made the decision that you're going to sell. You didn't talk to your tax advisor. And I've actually had businesses do that, where they sell everything and they say, okay, here it is at tax time. And then they're surprised at what the tax impact is. And you certainly don't want that. You want to make sure that the seller is getting the most they can for their sale, and that the buyer is paying a fair price and maximizing deductions. So that's basically the my outline of mergers and acquisitions. And I wanted to thank you very much for attending my portion of the webinar. I will be attending AVMA in July, and also the AAEP conference in December in Denver. I've also recently authored the book, The Vet Advisor: Are You Running Your Business, or Is It Running You? These slides will be sent out for anyone that either signed up for the webinar or attended, and they're going to have live links. So in other words, if you click on the book, it'll take you right to the place that it's for sale on Amazon, and it will also be available through Barnes & Noble in the next couple weeks. Here is a link for a white paper, which is basically in a very abridged version of the book, and my email address. And if I will offer a 15-minute complimentary call to talk about your practice and see if it's something that I can either help you answer questions, or if it's something that you'd like to take further down the line. And if that's the case, what I do next is actually schedule a discovery meeting, which is about an hour in length. That too is complimentary, but this way we get to see in greater detail what runs your practice and how you run your practice and your personal and professional goals. So from here, I'm going to turn it over to Justin Weaver, who is with Weaver Law. He specializes in veterinary, mostly, he said, mostly veterinary and some dental counsel. His contact information is here in his telephone, and I am going to pass the share button off to Justin, and he's going to set up his screens, and we'll go forward from there. Also, if you have any questions, please make sure that you put them into the Q&A, which is, you can find the Q&A buttons at the bottom. And please feel free to drop in questions. And at the end of the webinar, we will also open up for anyone to, that has put any questions in the Q&A, and we'll be happy to answer them at that time. All right, Justin.
All right, thanks, Holly. Can you see my screen? Did I do this correctly?
Yep, I can see it.
Perfect. By the way, I love surprises in reverse. I think I'm going to steal that moving forward. I'm going to use that. I don't know how often I get to deliver good news, unfortunately. Usually people hire me when it's time to deliver bad news. But the goal is to avoid that. So I'm going to start using that phrase moving forward. As Holly said, my name is Justin Weaver. I'm an attorney at Weaver Law. And thanks again, Holly, for asking me to join. We focus at our law firm, we have a very niche practice. And so we focus, as Holly said, primarily on the representation of folks in vet med. We do represent a few dental clients, a few other ancillary clients with similar businesses, but the bulk of what we do is in vet med. The first slide here lists some of the more common matters that we assist with: hospital sales and acquisitions, buy-ins, startups, employment matters. I also regularly assist clients with more day-to-day operational matters, regulatory compliance, employee handbooks, HR issues, those types of things. We don't do any type of litigation. I have some good referrals for those when we need to hook up a client with somebody that can assist. But generally, everything else that goes along with the operation of the business, we are able to assist with. I included my contact info at the bottom of this first slide. If anybody who is attending or watching this later has any questions or needs to reach out with any issues, feel free to reach out anytime. All right, so my presentation tonight is going to be similar and obviously piggyback on a lot of things Holly said, which was all great information. But what I want to focus here is some mistakes that we see in connection with folks who are either buying or selling a veterinary hospital. I think if I wanted to, and I don't, but if I wanted to, I think I could lead a 5-week seminar every day, going through all of the mistakes that I've seen clients make, or not clients, but veterinarians in general make in connection with the transaction. And so we're not going to get anywhere close to covering everything. But I do want to just kind of give an overview of a lot of things that I think if I were going through the process, I would like to know before I started. And the first, and by the way, my 5-year-old picked out this picture. He's very, very proud of it. And so I had to go with it. The first thing I want to talk about is what I think is probably the thing, if I had to pick one thing that you take away with you, this would be it from this conversation. And that is that how important it is to proceed with the right team of advisors whenever you're working through a transaction. And so I acknowledge that it is inherently self-promotional for someone who just told you they were a veterinary-focused attorney to sit here and tell you that the most important thing you can do is hire a veterinary-focused attorney, right? But I think objectively, this is one of the most critical things that you can do whenever you're working through a transaction. And the reason is we're going to go through some other things, and Holly went through some things that you need to be aware of when you're working through a transaction. If you have the right team behind you, it's always good to have that background information, but they're going to point out all the red flags for you. They're going to tell you what you should be doing to plan. they're going to tell you when you should run for the hills and you should get out of this transaction. Hopefully, that's not a common event, but look, that's part of our job as well. And so when I talk about your team of advisors, I'm really talking about the folks that I've listed here on the screen, or at least these are many of them. There are some others, but accountants, attorneys, brokers, lenders, financial advisors, coaches, consultants, all of these folks, you don't necessarily need all of them for every transaction. Uh, you're certainly going to need an accountant and an attorney for every transaction, or at least nearly every transaction, I would say. Uh, but these are the folks that can help guide you through the process. And so when you're thinking about this team, there are a few things I think you need to be aware of. Number one is who is the right person to be on this team of yours. You know, I look at it mostly from an attorney. Obviously, that's what I know most. But if you're hiring an attorney, what should you be looking for? Uh, Number one, you should be asking who that attorney or who that other advisor that's on this list is actually representing. You would think if you're hiring somebody and you're paying them, that they would be representing your interests. That isn't always the case. It should always, absolutely always be the case, but it isn't. There are folks out there who operate as what we refer to as a dual agent, which essentially means they are representing both the buyer and the seller in the transaction. And sometimes they have pretty good pitches as to why you should hire them. You know, they may say, or at least they sound pretty good, I should say. They may tell you that, you know, they're going to cut down on your costs, they're going to make it more efficient, they're going to make it less adversarial, because they're going to make sure that you reach the absolute neutral ground on this transaction, and you're not going to fight about anything, because that advisor is going to just push you all to the thing that is in the most middle ground that you can reach. First of all, that's probably not true. A true middle ground is tough to reach. Even if there is, you're now losing that person that's going to advocate on your behalf and that's going to tell you what you should and should not be doing solely on your interests. That doesn't mean you're looking to do something that's going to materially harm the other side, right? You're not looking to injure them financially or otherwise, but you are looking to reach the best deal for you and the best deal for your needs. The other thing with a dual agent that you need to understand is how that person is paid. And so this comes up most often with a dual agent broker who's representing both the buyer and the seller. They may only get paid if the deal is completed. And so they may be the most ethical person in the world, but there's an underpinning there that they only get paid if the deal closes. And so while they may be doing their best to represent both sides, uh, again, inherently, they're probably going to push towards getting the deal done, whether it's the right thing for you or not. The next thing I think that you need to consider is, what is the advisor's experience? You know, do they have experience in this particular transaction that you're going to work through? Uh, Again, looking at it through the lens of an attorney, if you are going through a divorce, you would not want me showing up to court for you. I promise you that. It would be a bad, bad decision. You know, I went to law school, I've worked in many firms, I've, you know, had a good legal career. I could not show up and figure out how to represent you in the divorce court, at least not well. On the flip side, you wouldn't necessarily want that attorney who works through divorces all day and does a great job representing you on your transaction. They're just not going to have the knowledge base to be able to assist you. You can take that a little bit further. And even if you have an attorney who works through mergers and acquisitions all the time, maybe represents Fortune 500 companies, does these types of deals all the time, but they have no familiarity whatsoever with the vet med space, you're also going to be leaving a knowledge base on the table that could be there to assist you through the transaction. We're going to look at some specific things in a few minutes, but I think it's important where you can, and there are a lot of good advisors, whether they're accountants, attorneys, lenders, even that specialize in this space. And I think you would be very well served to seek those folks out whenever you're working through this transaction. The question then comes up as we talk about who would be a good advisor. How do you find this person, right? How do you find this attorney, this accountant, whoever it may be that you need. The best advice that I could give, and this is how many of my clients find me, is to seek out to any other professionals or advisors that you're working with in the space. And so if you're working with me and I'm your attorney and I've represented you in reviewing your employment agreement, and you come to me and say, I'm looking to buy a hospital, I need an accountant, I can give you Holly's name. I can give you names of 5 lenders who would be able to assist you through the process. And that's not unique to me. That's going to be anybody that's working in the space is going to know folks that do a good job. And that is by far the best way to find a good advisor. There are also, obviously you can do your own research. You can look up folks. There's a number of ways to look up professionals that represent vet med. You can get recommendations from your colleagues, but it is important that you do this legwork to try to find these folks who can help you through the process. Before I hit click here to move on, I would be, lackey if I didn't mention that obviously fee and price does come into play when you're talking to your advisors. I think some folks overemphasize price or maybe make it the #1 criteria. That doesn't mean you go with the most expensive. Doesn't mean that the least expensive is not a good advisor. I think when I look at price, when you're hiring an advisor, you should look at that as a consideration. Make sure you understand what it is you're signing up for. But then I would, if you're able, prioritize all those other things that I talked about and make sure that you're getting the best advisors that you can. The next mistake that we see all the time, and this is really piggybacking off of what Holly was telling us about during her presentation, is just a failure to plan in general for your transaction. I can't tell you how many transactions I've had where a seller comes to me and says, I'm ready to sell, I'm ready to retire. What do? I want to be done in 4 months. It's like, well, okay, we're going to figure out a path. But this is something you really should have started planning for several years in advance, if at all possible. Obviously, there are circumstances where you can't plan and where there needs to be a rapid exit. But if at all possible, it's critical for both the buy and sell side that you plan before taking steps to either acquire or exit hospital ownership. I've split some of these considerations. Again, feel very much like an attorney giving you all these caveats. These are just a very generalized listing of some considerations that you should be making. But you can break them down into some kind of longer term and short term planning objectives here. And I think long term on the buyer side, what you want to be careful of is that you're not, as you're getting out of school, you're taking a job, you're maybe moving on to your second job, you're taking steps to be able to work towards hospital ownership. You want to make sure that you're not doing things that are going to limit your options once you're ready to do that. So Holly talked about non-competes. Non-competes are a big one, right? We want to make sure that you may have to enter into a non-compete whenever you take an employment position. I know that the industry is changing on how it views non-competes, but they're still out there. They're still very much enforceable in many states. That is a state-by-state consideration. But if you sign a non-compete, you need to make sure that you're willing to live up to that non-compete. And so if you're going to work as an associate in your hometown and you know your ultimate goal is to end up buying or starting a practice in your hometown, you're going to have to be very careful in signing that non-compete that may prevent you from doing so. Or if you do sign it, you may just have to plan even farther in advance and build in kind of a buffer zone where you go take that second job at another location before you move back and buy your hospital. The other planning, long-term planning aspect that we oftentimes see go awry with buyers from a long-term perspective has to do with financing, right? Most of our clients are getting third-party financing from a bank whenever they're buying a hospital. And in order to get that financing, you're going to have to go through the underwriting process with the bank. They're not just going to give you the money. And one of the things they're going to look at when you're going through that underwriting process is your liquidity. How much cash do you have in your bank account? What we oftentimes see for doctors is that as they lead up to wanting to buy a hospital, they do start to think about the fact that they're going to have to get financing. And then they start taking some actions that are actually contrary to their best interest in getting financing. So they'll go out and they'll take most of the cash in their bank account and they'll throw it at their student loans, right? They want to pay down their student loans as fast as possible because they think the bank's going to look negatively on their student loans. Paying down the student loans itself probably isn't going to hurt your ability to get financing. But if you're doing that in lieu of having cash in the bank account, that is going to hurt your ability to get financing. And really, banks are conditioned, or they're I guess okay with you having student loans. Most of their borrowers do, out of who have gotten a veterinary license or gotten a veterinary degree. The thing that they can't get past, though, is if you don't have any cash in your bank account to cover your debt obligations. And so, again, speaking to a lender, going back to that first slide that I said was the most important, a lender, an accountant, a financial advisor who can help you plan for what you should be doing to maximize your ability to get financing, your ability to get financing at the best rate is going to be critical for you. On the seller side, I'm going to skip over the first one, maximizing the value of your hospital, because again, Holly did such a great job of talking about that one. But that is a very long-term consideration. You want to start taking steps years in advance before you're ready to sell so that you can get the most out of your hospital that you possibly can. The other thing that you need to consider in maximizing that value is not only all of the financial aspects that Holly talked about, but you also don't want to start making operational changes to your hospital as you start to prepare to sell. So we've seen this many times where a doctor will come to us again wanting to sell. They may be even okay with waiting 2 years to sell so they can start taking some of these planning or satisfying some of these planning goals. But what they want to do is they want to start slowing down. They're not ready to retire yet, but they want to start cutting back a day and they want to start easing into their retirement. We have to have a conversation with them and let them know that's, you can do that, but let's consider your other options before you do and you start harming the value of your hospital. It may make sense to bring on a part-time associate to cover those hours. It may make sense to just not cut back your hours if that's a possibility. And so you need to just, again, if that's the decision you want to make and you're okay with leaving some money on the table for your lifestyle, there's nothing wrong with that. But I think it's important that you understand all of the options before you start taking those steps. There are also some short-term considerations that I've listed here. I think on the buy side, again, it's just incredibly important to understand the process and understand the timeline that you're going to work through. So if you're an employee, there's going to be a period of time where you may have to give notice to your former employer before you can leave. You need to build that into your timeline for buying. If you're buying real estate, in addition to the hospital, you're going to need to build in enough time to allow your bank to get an appraisal. That could take 6 to 8 weeks. You need to build in time to be able to get your financing in place. If you're relocating, you need to build in time to find a new place to live. Some of these things are certainly not legal considerations, but you need to do all of these planning steps as far out as possible so that you can make this short-term planning easier on yourself. From the seller side, we talked about avoiding operational changes. Another thing that we oftentimes see become very important to the seller is finding a way to maintain confidentiality about the transaction. And so you don't necessarily want your staff, in some cases you're okay with this, but many sellers do not want their staff to know that they're selling before they get to the point where they're actually ready to sell and they actually have a buyer lined up to purchase the hospital. Once the staff finds out that you're selling, it can cause some panic, for lack of a better term, for the staff. They don't know what that means in terms of their position at the hospital. This becomes even more of an issue we found whenever you're selling to a corporate group. Employees get very scared about what's going to happen to their position and their pay and who's going to be supervising them moving forward. And so planning out how you introduce the transaction to the staff, I think you can do it in a way that gives them sufficient notice, that eases their concerns, and that keeps them on board so they don't cause operational changes by leaving you in the midst of a transaction. And again, this is one where there are a lot of good coaches and consultants out there who are able to walk you through that process, attorneys as well that have been through this many times. The next concern, or I guess issue that we see a lot, is giving a third party a seat at the table whenever you're looking to sell. And what I mean by this is allowing anybody other than the buyer or seller the ability to dictate whether you can close your transaction. So for buyers, we've already touched on this. This generally involves former employers who you have non-competes with. Or if you're getting yourself out of a partnership, that can be fairly tricky in terms of working through the buyout of that partnership, any non-competes, any obligations you owe to your former partner. What I really want to focus here is on the sell side and how giving third parties a seat at the table can really cause issues for you when it comes time to sell. The most common one that we see comes up in a landlord-tenant situation. And so obviously this isn't an issue if you own your own real estate, but if you're leasing from a third-party landlord, this can become an issue for you whenever you need to assign your existing lease to the buyer who is not going to buy your hospital without the legal ability to occupy the real estate that you're using. And so oftentimes your lease is going to require that you go to your landlord and you get your landlord's approval in order to assign this lease to the buyer. Generally, landlords are fairly reasonable and they'll work with you to assign the lease. Sometimes they're not. I had a landlord a couple years ago who we went to them as the buyer and we tried to get an assignment of the existing lease. We weren't trying to change any terms of the lease. The landlord came back to us and said, sure, I'll do this, but you're going to have to pay us a security deposit equal to 12 months rent, which was a very large number for this space. And so we, representing the buyer, had to say, we can't do that. My buyer's taking out cash, they're getting working capital, they need this for the business. And we eventually got the deal done. We eventually got the landlord to come down a little bit, but the seller had to put up some money for that security deposit for my client, the buyer. Effectively, they had to reduce their purchase price in order to get the deal done because they had to move some money from the purchase price to the security deposit. In an ideal world, when you sign a lease, you get a provision in the lease that allows you to assign that lease to a buyer without getting the landlord's consent. We can't always get that. I'd say maybe 80% of the leases I do, I'm able to get that from a landlord. There are others where they just won't give you that. If they won't give you that, you just need to be aware of this issue and you need to start planning for it. Try to have a good relationship with your landlord. And you're going to have to approach them in a way where you're essentially selling this buyer as a great new tenant who's going to be in the space for many years, is going to, has good financial backing, all of those things that you're going to have to work through. But that can definitely cause issues with your sale. Some of these others that we've listed here, associate vets, we talked about the staff. Oftentimes, if a buyer is buying a multi-doctor hospital, they're going to require that your associates sign on with them as well. And so you're going to have to be able to work that transition. If you have a written agreement with that doctor that contains a non-compete, that can make this process a little bit easier for you if you're able to assign that non-compete to the buyer. But either way, you're going to have to plan and take some steps to transition those doctors over. One of the biggest ones that we see is actually the long-term lab agreements that doctors will sign with IDEX, Antec, Heska, all of the lab providers, where they'll give you a piece of equipment, they'll give you discounts, they'll give you some benefit in exchange for signing a long-term agreement that requires you to either hit certain minimum levels of usage or requires you to exclusively use that lab for certain tests. Whenever you sign those agreements, they are oftentimes 5 to 7 years that you're committing to that lab. And if you are ready to sell before that 5 or 7 years is up, you're going to have to either terminate that agreement, which under those agreements, generally that means you're going to have to pay a whole lot of money back to them. They're going to require that you pay back a lot of those benefits that they gave you, or you're going to have to get the buyer on board with assuming that liability from you. And so again, if you're looking to sell in a year, probably shouldn't sign a 7-year lab agreement unless you have a buyer that has absolutely told you they're willing to take that on. All comes back to planning, all comes back to being aware of these things as you're looking to sell. Already talked about a lot of this stuff that's on this slide, but I think this goes back to what we were talking about before of having advisors, having folks that have been through this type of transition before. There are a lot of considerations for you that are going to be industry specific that you're going to have to deal with as part of your transaction when you're buying or selling a hospital. You're going to have to deal with inventory, and oftentimes you're going to have to deal with controlled substances. What do you do with the expired controlled substances that are in the hospital? You have to have a mechanism for how you deal with that. You may be dealing with vendor rebates. A seller purchases a certain level of inventory or provides a certain level of services, and in exchange, the vendor sends them a check every quarter that can be, tens of thousands of dollars. Oftentimes, in a asset purchase agreement, as Holly referenced, it's going to provide that all of that money that's incoming becomes owned by the buyer. The buyer purchases those things. And so if you have a sizable amount of vendor rebates coming in, you're going to want to make sure that you exclude those from the deal as a seller so you can continue to collect those. You were the one that did the work, so it's fair to expect that you would receive those actual rebates. Again, all of this other stuff goes to the same idea. When you're transitioning a hospital, you're going to have to deal with things like what happens to your accounts receivable. Oftentimes, sellers retain ownership of the AR, but you have to deal with how you're going to collect that post-closing. Is the buyer going to collect it? Is the seller going to collect it? If the buyer does collect it, is the buyer entitled to a fee in exchange for collecting it? And so all of these things are going to have to be addressed as part of the transaction. And wrapping up here, I think this is a very, very high level takeaway and not something that you can just take and directly apply in your transaction. But one of the things that I see all the time that throws a deal off the tracks, whether it's on the buy side or the seller side, is that a client focuses on the wrong issue or focuses on an issue that frankly just shouldn't matter. I had a colleague that I worked with several years ago who called this the dreaded P word, right? Principle. Making a decision based solely on principle. An example that has come across my desk, probably a dozen times at least, is a seller who has told me, is the day that I stop working here, I'm retiring, I will never work again. In fact, and then we get a non-compete in the purchase agreement, and it's probably a little aggressive. It may be a 30-mile non-compete for 5 years after the deal. And the seller says, no way, I'm not signing that. Under no circumstances will I sign that. That's unreasonable. That's offensive. I'm not doing it out of principle. And I have to have a conversation with that person and tell them, we can push back on this, but if you're moving from Pennsylvania to Florida the day after the closing and you're never going to practice again, why do you care? And so sometimes my job is not only fighting for things that we want to get that benefit our clients, but it's frankly probably just as often educating clients and telling them not to focus on this thing. This is not something that's going to impact you. Let's give this to the other side and use this as leverage to work on some things that we actually do need, or things that will impact you. And so again, I think I said the the first slide about picking the right team is the most important takeaway here. This might be the second, and hopefully if you have the right team behind you, they're going to help you focus on the right issues. So that's all I've got, Holly. Thanks again for asking me to join, and appreciate you giving me the opportunity to put some of this out there.
Oh, thank you so much, Justin. Actually, you raised some really good points, and I don't have any questions in the Q&A at this point, but if anyone has any, please drop them in and we will address them. But one of the things too, you mentioned about the buyer, coming out of vet school with the vet loans, and lenders are actually looking to make sure that you're current. The other thing too is credit score. So sometimes you want to make sure that you're taking care of the credit score. You want to make sure you have the cash available, and that'll also give you a better option for lending. And then you mentioned about the real estate, like if you're buying the real estate of the sellers, or are you buying the practice? And sometimes, also the other questions that can come up is, how are you going to hold that real estate? And what is that lease going to look like if you are leasing back to yourself or temporarily leasing back with the seller? So those are some things that you brought up that I thought were great, along with dual agency. I actually have been in that situation, not only transactionally, but also with divorced clients. I've had people when I was doing, preparing tax returns, and that, both parties would want me to prepare their separate returns. And I'm like, no, I can't, because I can't give you the best advice for you if I'm counseling both sides, because then you're right, you do come to the neutral area. And so you want to make sure that the buyer and the seller have the best team on their side so that they get the best advice. That was really good suggestion.
Yeah, thank you. I probably shouldn't start with that one because I could go off on that issue for quite some time. But yeah, I always think about the dual the dual representative is, they're almost trying to be a referee and coach both teams at the same time, and that's just you can't do that. And so yeah, something that you really have to stay away from.
Yeah, and it's almost as though you're going into the transaction as if it was arbitration versus really trying to get the best deal. And what I was talking about, that the buyer's objectives as to how they define those assets is going to be different from the seller. So how can one person counsel both and come up with the best number for both? That's part of where the negotiation comes in. But, we definitely want to make sure that the buyer is aware of what their their focus should be versus the seller. So really good. All right. Well, let me just check the Q&A again. Oh, we got one. What trends have you seen as more practices are selling corporate rather than private veterinary buyers? That's the one question. And concerns or differences in the process to keep in mind as a future seller. That's a really good point. We were just talking about that before we got on the webinar. I'll let you
Yeah,
take that.
I think that's a really good point. Really good question. The difference between a corporate transaction and what I refer to as a private transaction are vast. A couple quick takeaways. Number one, when we're talking about planning as a seller, you should expect in that transaction that you're likely going to be required to continue to work for them for 3 to 5 years after the sale. They're not coming in with a new doctor to take over your position. They're buying in and expecting you to continue to transition that hospital and operate that hospital for them post close. The other difference, while you could talk about this as well, there's certainly an opportunity to make more money on a corporate sale. The way they're going to structure that is oftentimes going to be very creative in how they do so. It's not going to be a lump sale for the most part. Occasionally, we see those, very rare today. 4 years ago, we were doing them all the time. Not anymore. Generally what we're seeing is a mixture of some cash up front at closing, maybe 40% of the purchase price, some type of note that you're required to hold where you're being paid over several years post closing. And then oftentimes they're requiring some type of joint venture where you continue to own a piece of the practice moving forward. And there are all kinds of concerns and risks associated with that. Once you start taking money off the table at closing, even though the total enterprise value is generally going to be higher, there's certainly a lot more risk involved with a corporate deal as well.
Yeah, and then like what you're talking about with the joint venture, that's kind of a um, based upon an installment sale basis, but also you are, they'll have profit sharing as a contingent, and then you have certain benchmarks that you have to make as a doctor, and that may be entirely differently from the way that you've operated your practice in the past. So you really have to be clear on what their expectations will be, as the seller and getting into that situation.
Yeah, for sure. Not to mention, you're as the seller who may have owned your hospital for the last several decades, you now have a boss for the next 3 to 5 years. So just mentally, you need to be on board with that.
Yeah, actually, that would probably be very challenging for me because the only person I've worked the longest for is myself.
Yeah,
So I can understand that. So that's the last of our questions that I have so far, and I really thank everybody for attending. As I said at the beginning of our presentation, this is being recorded, and we have two sets of slides. We're going to make sure we send that out to everyone that signed up for the webinar as well as those that attended. The recording will be set up. It is accessible. I did actually use Zoom the last time, and I don't think that was quite as accessible. So there's going to go up on YouTube, and that way, people can view it a little bit more easily. If there's any future questions, as I mentioned, I offer a 15-minute complimentary conversation. It's on my website. Schedule a call. Happy to answer questions, get to know you, that type of thing. And I'm sure that Justin mentioned that he is equally as interested in having those conversations to, see where things go, or if you have questions.
absolutely.
Okay, anything else to add? I
No,
think
I
we're
think that's it. Thanks again for putting this together, Ollie.
Oh, thank you very much for being with us. I really appreciate it.
Of
And good
course.
luck with your practice.